Okay, Q&A for the last market outlook. A couple of the questions I got were about agencies' year-end earnings. There was some concern about the lower dollar roll and net spread income, but keep in mind their share count increased over the quarter. We'll look at it on the next screen here. I listened to the conference call and I took notes and I condensed them down into a couple of pages to give you the highlights of what they were talking about. The reaction wasn't negative. The price reaction wasn't negative. It wasn't wildly positive, but it wasn't negative. Overall, it was they didn't really give guidance, but they sort of gave a description of a market that they were going into that is beneficial for them. So they outlined three big things that were going to be tailwinds for them, and then made a really bold statement. So I'll show you that statement. So they start out by saying the investment outlook is decidedly more favorable going forward than the past 2 years. And they note three things. Now I can't write on this because this is not my sketchbook application, because I have it open in the background with something else on it. So I'll try the best I can to put some kind of underlining or writing on here. So you have one over here, one here, and one here. Here are the three things they point to. Interest rate volatility is expected to decline. They point to the MOVE index still being 50% above the 10-year historical average. In case you're wondering, how much volatility would still have a possibility of declining. Why is this important for MBS? Keep in mind, when we price out MBS, we can't just do it based on cash flows and spot rates, because, well, we don't know the cash flows. We know the principal and we know the interest, but we don't know the prepayment. We don't know the prepayment speeds. Now, they do have estimates of what the prepayment speed is, but you need a binomial tree to get that done, because you need an estimate of interest rate volatility. Remember level 2, when we priced out a bond with an option, a call option. We are short the call option. The higher the volatility, the higher the value of the call option. It squeezes out some of the value of the bond. It's the same thing in MBS. The mortgage holder has a call option. At lower interest rates, the mortgage holder can just pay off the mortgage. So you have to model the path of forward rates to determine at what nodes in the tree would you get increased prepayments. So MBS has negative convexity because you have an implied short call. If volatility increases, the call option value increases. As volatility decreases, the short call value drops. Therefore, MBS prices would rise simply with dropping volatility, because it would take out the value of the call option. So it's important we understand how interest rate volatility affects MBS pricing. Number 2, they point to the spreads. They were talking about spreads on MBS over the 10-year, ranging anywhere from 140 to 190 basis points, and pointing out that the 10-year Treasury has got a government guarantee. The agency MBS has got a de facto government guarantee. Why are we getting 190 basis point spread on something that is basically the same thing in terms of the issuer? So they were, in October, they made a point of noting that spreads had widened to about 190. They issued shares. They had an at-the-market offering. They issued shares. They bought into that. Their asset yield increased. We'll look at the next page. And then they decreased in the fourth quarter to about 139 basis points, still relatively high, but that helped their performance for the fourth quarter. So they expect the spreads to continue to contract, and therefore price would go up. So if you combine the spreads contracting with volatility dropping at the same time, it opens up the opportunity for higher possible leverage, because they did decrease their leverage quarter over quarter from 7.9 to 7. And remember, they hedge out the interest rate risk and they lever up the spread. They use a lot of leverage on that spread. So if you have lower volatility and tighter spreads coming, you can step into higher leverage because of that. And finally, lower expected rates from the Fed for 2024. This lowers the need for and the cost of interest rate hedges. lowers the cost of your interest rate hedges and lowers the need for your interest rate hedges. If you feel that rates are going up, what are you going to do? You're going to hedge and perhaps over-hedge. Well, over-hedging has a cost, right? There's a cost to your hedge. If you think that rates are going down, you would reduce the amount of hedging that you're doing, maybe even under-hedge. So it lowers the need for hedges and it lowers the cost of hedges. So think about these three things. Interest rate volatility expected to decline, lower volatility, lower short call price. Spreads expected to decline. Combination of those two mean higher pricing. And if you have lower rates from the Fed and you underhedge, you'll get some value from the interest rate exposure that you have left on your assets. So the performance for the quarter wasn't bad. 12.1% economic return, made up of 36 cents return to shareholders from the dividend and 62-cent increase in book value per share for Q4. A 64% increase in the book value. That's pretty impressive. 860 is what they ended the year with, and they gave some update for January that book value per share is up another 1 to 2% for January. Now keep in mind that 62 cents is on top of an increased share count. They did issue shares over Q4. So it is, I think they raised 1.1 billion by selling 110 million shares. So it is up 62 cents on increased share count. And when you look at the net spread and dollar roll income, it's down, but on increased share count. And it's not down that much. And historically, those are still very good spreads in dollar rolls. EPS for the quarter was $1 per share. The previous quarter, their EPS was negative 102 because they had mark-to-market losses. Now they had mark-to-market gains. And if we think these three things are in play for 2024, then their mark-to-market gains should continue, which will increase their book value per share. Let's look at the next screen here. Asset yield is 4.47%, leverage is 7. Let's see if I can get the pen working again on this screen here instead of just those lines. 4.4, no, well, you'll have to live with this. 4.47, leverage is 7, down from 7.9. Their average repo costs are 5.48, but they have interest rate swaps in place. The average cost of funds is 1.39. So you have an average asset yield of 4.47, average cost of funds of 1.39. That's up quarter over quarter from 1.17. But if we think that the Fed is done raising rates, the average repo cost isn't going to get much higher than 5.48. In fact, as the Fed cuts rates, this will start to drop, and their average cost of funds sitting at 1.39 is still significantly lower. Hedge ratio 112% versus 116 for September 30th. So they've lowered their hedge by 4%. They're still over-hedged. I would like to see that come down to an even hedge, maybe a slight under hedge, and I would like to see for the next quarter at the end of Q1 2024 here, I'd like to see the leverage go from 7 back up to maybe 7.9 or 8, where they ended September with. Get this hedge ratio down to 100. The net spread and dollar roll 60 cents a share, still quite strong. There was a large share count for the quarter. They issued at a premium to tangible book value per share. So the shares they did issue in Q4, they said were issued at a, and these are their words, meaningful premium to tangible book value per share. Well, that only helps everyone else. Now, if you're concerned about the 60 cents, the net spread was up 5 basis points. So the spread improved. It's just you had a larger share count, right? Here's their bold statement. Expects the Fed balance sheet runoff to stop in 2024. To stop. Not just taper, but to stop in 2024. Now, I know that it's probably going to be a topic of conversation next Wednesday in the press conference. And at some point in the minutes, we'll see that they are talking about slowing the pace. They'll start with slowing the pace, not stopping. And I think sometime in May, they'll have to start thinking about a date at which they'll start to taper. You know, sometime in the summer or third quarter, they may start to taper. But agency here, the executives are suggesting that the Fed is simply going to stop the balance sheet runoff in 2024, not just taper. I think that's a bold statement. anyways, there's a very quick recap of agency. Remember, when we buy something, we buy the future, right? And the future, if those three things come in play, lower interest rate volatility, lower rates by the Fed, even if we just believe the three from the Fed, lower rates by the Fed, and if you get lower volatility and lower rates, that spread should calm down and contract. Those three things are all beneficial. So if management can lean into leverage at the same time, then yeah, things look good. Lean into leverage and get your hedge ratio down from 112%, even just to 100%, but a little bit of under hedging. Maybe not for the first quarter. If we think they're cutting rates in the third and fourth quarter, maybe wait till second quarter before you start to under hedge, but at least come back to a normal hedge. That would be a nice result for Q1. So there's agency. Let's get this off the screen and let's get to some questions here. I'll just slide this off and get that out of the way. And here we are. What are the things you are looking at when reading the press release 10QK of a utility company? The big thing for a utility company is regulatory assets, right? The growth rate expected in regulatory assets, because you're saying typical revenue, EBITDA margins don't matter as much. Not really, because they're really regulated, and their rates start from a desired net income, and then costs are added on to figure out what revenue is needed. They figure out how many customers they have, and then they know what rates they need. It's all regulated. But the regulator approves assets, and the return of a utility company is based on the level of assets. So what is the projected growth in regulatory assets? You want to see this somewhere in the 6 to 8% range, which is pretty aggressive, which means your dividend should increase at 6 to 8%, which means your price should increase at 6 to 8%. So if you have a dividend yield running about 4 to 6% on a utility, and you're getting 6 to 8%, you're getting a 10 to 14% expected return, what the stock would supply to you in terms of return. For somebody looking for interest rate sensitive product with low volatility, that's a pretty good return. The nice thing about utilities is you're getting a dividend, which is taxed at a lower rate than interest, so it's much more tax efficient, and it is very bond-like in its pricing. But growth in regulatory assets. Is the longer end of the yield curve already pricing in 5 to 6 cuts? Well, it's hard to tell what the longer end of the yield curve is doing. The cuts come from the federal funds rate. The central bank does not cut long-term rates. The market sets long-term rates by how they buy and sell bonds at the long end. So it's hard to tell what is priced into the long end of the curve. We have an inverted curve, so prices may be priced in, or lower growth may be priced in, or lower inflation may be priced in, or a lower term premium might be priced in, or a lower liquidity premium because of increased supply may be priced in. Hard to tell, hard to tear that apart. So all we can do is look at the Fed funds rate and determine how many prices are cut in there because it's clean, or how many cuts are priced in there because it's clean. Any chance we'll get something on tax efficiency in the applied series? Hard to do, because am I doing it for Canada? Am I doing it for the US? Am I doing it for the UK? Am I doing it for France? Am I doing it for Australia? Which country would I be doing it for? Because I would have to do it for the tax laws in those countries. Because there are tax treaties going on all over the place, right? So you got to know where tax treaties happen. I'm just drawing lines at random here to show you that, what I could say for Canada may not necessarily be true for the US, especially when it comes to real estate and the ability to carry your profit from one property to another property depending on how you buy and sell. That's not true for every country. So it's hard to do a tax efficiency video that wouldn't be so country specific as to only appeal to a few people. TLT up, XLU down. What's happening? Well, the market is got a random component to it, and all sorts of things can happen. The market is not if A, then B. It is not that. If the market were that, anybody with a computer science background would recognize that as the start of some code that you could code in. If you had an if A then B, you got an if then statement. The market is more like if A, maybe B, but maybe not. Maybe C, but maybe not. Maybe D. Maybe B if C and D are present. Like it's so when we look at relationships, you have to look at it over longer periods of time, not over the last, hey, listen, the last hour, interest rates were, yields were going down. How come XLU is not going up? It doesn't really work one for one that way. The market has tendencies, not relationships, not programmable relationships to that extent. It's a probability distribution. Some relationships have higher probabilities than others, but in the end, there is a random component to the market. So it could be that there was a fund that was that day a significant fund that decided what we're going to do is we're going to underweight the utility sector and overweight the communication sector, let's say, or information technology, and was doing distribution in the utility sector that day and selling utilities, and there was selling pressure when they should have gone up because of the fundamental change in yields. They should have gone up, but there was, who knows, right? From day to day, trying to say, well, this went up because of this and this went down because of that, that's tough to do. How are you going along the Indian and Mexican markets? You can usually find ETFs if you're looking for U.S.-based ETFs. I know there is one that tracks the Mexican market, EWW. I'm not sure about one for the Indian market, but if you have Interactive Brokers, you can go right into the Mexican and Indian markets and buy an ETF that tracks their major exchange in pesos and in rupees. Technical confirmation could also come from another big green high volume candle closing at the high, and I think we may even get another one of those today. Netflix just knocked it out of the park as I'm doing this early Monday morning. Futures are up over 20 points. Index is well over 4,900, and looks like we're going to keep going. Been contemplating recently about the recession. Theoretically, I think you're right that we shouldn't escape a recession, but if I'm not mistaken, recessions do not simply happen. There is actually a crisis somewhere out there, and then spreads and affects the whole economy. There usually is some catalyst, yes, and starts a chain of events, but I can say with almost 100% certainty, that's bold, that whatever happens out there, the central bank and government will come to the rescue with unlimited money. If it's big enough, yeah, the central bank will step in. Ultimately, why even bother anymore thinking or contemplating about recessions? You could also make the case that a recession and a crisis started last year with Silicon Valley Bank. And as we know, it was stopped by the unlimited money from the Fed. Look at SPY and its multiple. Record highs and a multiple above 20. At what was a year of no EPS growth, wars breaking out, fears of world wars, general uncertainty everywhere, polarization among people, protests, recession fears, and so on. You can go to almost any year. 1972, look at the headlines and you can see the same thing. You could see the Middle East agitating, higher oil prices being threatened by OPEC, the Vietnam War going on, polarization of the citizens in the U.S., the anti-war crowd against the Nixon Republicans, the heavy handing of the police for demonstrations against these anti-war hippies. They were, like, get these hippies off our streets. I mean, you can go to almost any year and probably see the same headlines. That noise is always out there because the world is full of humans, and that's just part of the human condition. It's not like it's those people or those people. No, it's humans. You put enough humans together and you can generate, by just observation, headlines that are negative. Well, these people aren't getting along. Those people aren't getting along. These people fight broke out among these people. Crime over here, murder over there. That's the human condition. So it is always with us. So I don't know that pointing to those helps the conversation on that one. I agree, Meldosta, you said. However, this time around, I do not believe the Fed will be able to step in and print endless money. I believe the crisis will be too severe, and the Fed will be beholden to the impact the endless printing has on inflation. Yeah, it could be. It could be the recency effect that we just got through this heavy bout of inflation. That if something happened that wasn't too serious, but was causing the market to drop, unemployment to increase, the idea of re-expanding their balance sheet and flooding the market might not be. They might not be as willing, having come off a bout of inflation. That maybe that might stay their hand. Good point on Fed stepping in, but for us investors, it's also a time to buy cheap because the Fed steps in fast. The recession and market dip is short, but still enough time to deploy capital. That's true. It's not like you're going to escape a sell-off. If something big happened, we're at 4,900 now. You could get to 4,000, 39, 3,800 before the Fed really starts to do something. Because if the selling begins to accelerate and there's no end, the Fed will step in at that point and start to do something. If asset prices everywhere are cratering. And the nice thing is when the Fed steps in, who gets paid first? The investor gets paid first. The investor always gets paid first because we're front of the line for the type of intervention that they do. I also bother and cover core positions with calls, puts, the closer the probability of recession likely comes. So to me, it's still relevant despite the action we know the Fed will make because even a shorter intervention period still creates investing opportunities. True. Let's see. Can you do a video on historical and leading economic indicators with the most predictive power? They change over time. It is a cohort of predictors that right now have probably more predictive power than others, and they do change over time. But the LEI, which is a leading economic indicator index, it's an index of leading economic indicators, probably has the best predictive power when you combine a lot of different indicators into one as opposed to just using one indicator. And a history lesson doesn't help in the market because we have to play the future. So, what happened in history, yeah, that's nice to talk about. Maybe it makes the basis of a good book, but it's not helpful going forward. Do you think the XLE can outperform this year? Outperform this year. The shorter the time period you get, the harder it is to determine whether it can or cannot outperform. I know that you have consolidation in the industry going on. You have an unwillingness for greenfield CapEx. Greenfield meaning, hey, there's a piece of land, there might be oil under there, let's start drilling. You're more likely to get brownfield development, which means, hey, we got this piece of land, we got 2 wells on there, we're taking oil out of the ground, let's put another 2 wells. Or let's go to enhanced oil recovery. Let's inject water, let's inject CO2 and do that. So that means that when CapEx is low, free cash flow is high because your free cash flow takes out your CapEx. So if your CapEx is dropping, your free cash flow increases. Have a look at a company's free cash flow to market value. That is their free cash flow yield. Some are up around 15% right now. 15%, which means if you bought one of these companies in 6.5 years, you got all your money back. And you still own the company, and oil is not going away in 6.5 years. No matter what the lefties want to shove down your throat, it's not going away in 6.5 years. Not going to happen. So can it outperform? Yeah, it can. It's not on my conviction list of saying it can outperform, but if I had to deploy money, I'd certainly put some in XLE simply for that cash flow yield. And I'd probably find ones with really nice cash flow yields in the Permian Basin that could be the potential for a takeout. Oxy seems to be my favorite one there. I think Buffett still wants to do one big grand deal before he goes away. This seems like an obvious one when you already own 27% of it, right? What level are you going to sell TLT puts? Which period? Well, if you sell puts, you're anywhere from 30 to 45 days out, and not too far away because you want some revenue from it, and at a price that you don't mind accepting it. So I don't know, 90 the 94s, 93s, 92s. If I wanted to be really aggressive, I might sell a 96 put for May, thinking that if as each Fed meeting goes by, we're getting closer and closer to a rate cut, the market will begin to price it in that TLT will probably be well over 100 before the first rate cut actually happens, because it will be anticipated. What is there no equity in the Fed's balance sheet? Well, it doesn't need equity. It has no shareholders, really. It doesn't need equity. It's owned by the banks, in a sense, and every year it returns all its money to the Treasury. So it really has no equity. I understand you like both XLU, TLT. Is XLU not a better buy? However, given the uncontrolled debt and deficit and similar coupons, wouldn't XLU be better? Well, XLU could be, but XLU has management, right? But a 30-year bond duration doesn't have management. You have supply and demand issues, but every country has supply and demand issues. So if you're thinking, well, let's find a better bond, where are you going to go, right? If you're a bond investor and find a better bond, find a better sovereign bond, where are you going to go? Canada? I don't think so. What was the point of buying a negative yield bond? Well, negative yield bonds were being bought. If you have a period of deflation where you think there's the zero line, and you have a period of deflation, and your job is to preserve the purchasing power of a group of assets, and a bond is yielding here, let's say negative 0.5%, and you have 2% deflation, well, guess what? The purchasing power of your assets is increasing 1.5% even by accepting a negative yield. And if you think deflation will continue even more, a negative yield is a very high price. If deflation is going to keep going down, the negative yield might get deeper, the price may increase. You're not holding it so much for a negative yield. Nobody likes a negative yield, but it is, if the real yield is positive, it doesn't matter what the nominal yield is, as long as the real yield is positive. Let's see, consumer discretionary stocks tend to rise and fall first because of highly elastic demand, making a leading indicator. That's true. What do you think about indicators like monthly goods and services tax collection, airline traffic, automobile sales? Would they also work as good leading indicators? Those sound more like coincident indicators, right? Automobile sales, airline traffic is what I can see happening right now. I don't know that it's leading. So if I'm looking at airline sales and I'm looking at the number of tickets sold today, or the number of full seats today, that doesn't tell me what next month is going to be. It just tells me what today is, and maybe it was a weather related thing that I'm looking at. A certain percentage of the fleet was grounded because doors fly off when in the air, something like that. It could just be something like that. So that sounds more coincident than leading. I notice that U.S. interest rates and currency exchange rates tend to have a notable impact on market volatility of the country I reside in. Yeah, okay. Would you say that it's important to keep track of rates and returns of various foreign countries, not just the U.S., because of potentially large capital outflows? Well, yeah. I mean, what I do, I play the U.S. market, so I look at the U.S. market. I mean, if I just stayed in Canada when I was there, I would just look at the Canadian market, because I'd be investing in Canadian assets. What matters to me is the Canadian yield curve at that point, so I'd be looking at that. But because I look at the U.S. market, that's what I do. But what you can do if you're in the U.K. is you could say, okay, well, I'll go through the same process, but I'll just use the U.K. market. So when you're looking at yields, look at U.K. yields. When you're looking at central bank activity, look at the Bank of England. Don't look at the Fed. I do it based on American data because I hang out in the U.S. market. But you would do it for your own country. Let's see. Do you have plans on covering investment styles like large, mid, small cap, or value growth? That is factor investing. There is a video in factor investing in the sector studies in the folder for top down. You'll find a factor investing, and in there, yes, I do cover factor investing, because what you're talking about with styles, they're basically factors, right? The large, mid, small, that's your size factor. Value growth, that is, well, you can call it the value factors. The first one is SMB, small minus big. The other one is HML, high minus low. And if you combine it with beta, you got the Fama French three-factor model. So these styles are factors. So yeah, you can watch the video for factor investing. Under the impression you rarely buy options, that is true. Under what macroeconomic circumstances would you buy a straddle in the index given implied volatility is low? Buy a straddle. I get the idea. If you buy a straddle, the market's going to go one way or another. I don't know that I would. I don't know that I would do that. I guess if I had to buy a straddle, it would be on the SPY, because I could go either way. There are good reasons why we could go higher. There are good reasons why we could go lower. We could go either way, but I'm sure that because I think that way, a lot of people think that way. The options, the at-the-money options, would be priced in. Yeah, you'd have to go, and straddles, you kind of want something to happen one way or another. What you don't want is a slow grind, because theta will destroy you, because you're getting destroyed on theta on both sides. And if you have interest rates that are coming down, if you do like 6-month options and you do have interest rates coming down, the lower interest rates tends to lower the price of the option. You have that working against you as well. I don't know. Whatever leads me to buy a straddle, I'm sure leads other people to buy a straddle, so that they're priced in. What impact do mortgage applications going up, housing index going up, and building permits going up have on housing stocks? Well, it all speaks to sentiment. It all speaks to a better environment to operate in, right? If equity index futures are simply the result of a mathematical formula, what causes futures to swing wildly, sometimes overnight? Well, the cash market is closed. So when the cash market is open, which is 9:30 to 4, futures will be a mathematical result of whatever the basket of stocks are. So S&P 500, whatever those 500 stocks are trading at, the futures price will follow those pretty much penny for penny in terms of the formula of getting to the futures price. Once the cash market closes, then it's sentiment that drives the futures. So if we see futures strong in the morning, we expect that the cash market will open strong. Now, if the cash market doesn't, the futures will adjust to the cash market price very quickly. But we can always say, you can always tell where futures should be versus fair value. When we say futures versus fair value, that is the underlying e to the r minus qt, right? That would be where the futures price would be for fair value. And then you could look at where it is versus fair value, and you could say the market is implying a 10% or a 10-point cash open based on where the futures are versus fair value. Like they're 10 points above fair value, that sort of thing. Where do you see DHI in the next 6 months? I don't know. In the next 6 months, I really don't know. I don't see the housing market turning around so much in the next 6 months that it destroys the investment thesis. That's about the best that I can say. But what price do I see it at? Where do I see it at? I don't know. Nobody knows. Nobody knows. You just have to look at the investment thesis and say, is the story still in place? And if the story is still in place, you have to trust that management knows how to take advantage of those environments. If you have a good management team with a good track record, they can take advantage of a good environment. Is the investment thesis still in place? If it is, there we go. How the market will respond to that, who the hell knows? Nobody really knows. But do I see it selling off to $90? Probably not. Will it touch 120 before it touches 180? Maybe. I don't know. But 6 months, I mean, I really just don't know. Do you feel like the market reaction to DHI's results was overblown? It had fairly good guidance. I think what it beat on revenue. The margin, the 100 basis point loss on the margin, yeah, that kind of sucked on that one, and that was because they offered a lot of incentives to get the revenue. But they are guiding to higher home sales. They did raise their guidance in a number of areas, but they did have a good run. That's the point, right? I mean, from the lows of October 2022 to the end of 2023, many of these home builders were up 100%, if not more. The home builders really, if I just gave you the numbers, you would think that it was the Magnificent Seven. Why the home builders were not included into like the Magnificent 10 or 12, I don't know, because they were performing just as good as everyone else was. Met up 100%. Yeah, but so were the home builders. Right? You didn't have to think too hard for that one. They had a good run. That when you see a little bit of a slip like that there would be some profit taking is not surprising. It's not surprising. In terms of different coverage of companies, IBS, they may be showing only stocks with analytical coverage to compare earnings with estimates. Every stock in the S&P 500 is going to have analytical coverage. Every stock is going to have analytical coverage. And it really is only just showing the S&P 500, and they have been off for quite some time now. It's been 3-4 months where their earnings calendar has just been off, where I know a company is reporting earnings because I'm in it, and they just don't have it on their list. So how can I tell when calls are cheap or expensive? IV, implied volatility. The lower implied volatility are, the cheaper they are. That's how they're priced. The price relative to IV, that's not how they're priced. Sorry, that's how we determine the value relative to IV. If IV is elevated, they're expensive. If IV is really low, then they're cheap. No matter what the price is, they'd be considered cheap because of the low IV. Maybe I'm missing a baseline video, but where do you get the probabilities like 35% less for 3 rate cuts? You go to the CME site. You can Google something called Fed Watch Tool. All right, so let's write that down. Fed Watch Tool. Google that, and it'll bring you right to that site on the CME. Let's see. Do you know where to find Canadian implied rate cuts? Yeah, you can. But good luck trying to figure out what the hell it means. They give you this grid, and you're looking at it, and you're saying, well, I can't figure out what the hell this means. Like, how do you interpret this? And there are no notes to interpret it. It's like, here you go. It's like, well, okay, I get that you don't want to tell us. Why not just not tell us instead of give us something like this where it doesn't make any sense to anybody? I can't figure it out. Maybe you can, but you can get it. I think the Bank of Canada has it. Thoughts on Canadian housing inflation affecting Bank of Canada's decision on cuts? I don't think they're going to look at that, because that is something they cannot solve. At this point, it's something they can't solve, but they can certainly destroy a lot of value because of the nature, the interest rate sensitivity of the Canadian household. I don't know that they will continue just because of housing inflation. It is well known in Canada with the amount of people the Liberal government wants to bring in, the sheer amount of people even being told 2 years ago that this is going to create a housing issue. Doesn't matter, these people vote Liberal, let's bring them in. Let's bring as many in as we possibly can. I need to win. And then doing the stupid thing like capping the amount of international students at universities. And Ontario and BC will be hit the hardest. And even some of the schools warned, if you do this, we won't exist. We will cease to exist if you do this. Tough, tough. You know, it's party before country. Party before country. This is where we are with politics. But I don't think that the Bank of Canada can stay on that fight knowing that it is a group of imbeciles causing the problem. And monetary policy can't fix stupidity. You know, so you have to let some things go. If mortgage rates drop and immigration keeps this pace, it seems housing prices have nowhere to go but up. That's right. I just got used to saying 40 million Canadians, but with Q3 23 estimates from Stats Canada, I'm going to have to start saying 41. Yep, you probably will. Got a couple of questions for you. LEI index does not capture much data from the services sector. That is true. That is, I mean, that's a fair criticism of the LEI. That's a fair criticism. Almost all the non-financial components are from the manufacturing sector. Manufacturing is 18% of GDP now. So does the index really matter? Yeah, well, that is a good question, right? Not to say services are not doing good, because services at PMI did come in lower than expected. I can't push back on that, because it is a valid criticism that perhaps today, given the overwhelming size and value of the services sector, that maybe this just doesn't matter that much. Atlanta Fed's GDP now is at 2.4 for Q4. And we'll find out Thursday morning, right? Inflation won't come down linear like you said. Does that make you feel uncomfortable being long TLT? Nope. Do you hold TLT only because you think something will break? No, not really. No. I hold TLT, and I like duration probably for the next couple of years, because I think we live in a deflationary world, not an inflationary world. And we will go back to pre-2020, where you couldn't get inflation to show up no matter how much you tried. I think that is the world in which we live in. Technology is finding its way into our lives more and more and more. Technology is deflationary. And the more it finds its way into our life, it's the point that technology is on almost every device. It's taking over, little things that we used to do before. Now there's an app for that, and that's just going to continue. It's not going away. It's going to continue. When you see Duolingo laying off its contract workers because its AI, its generative AI program is doing just as good. And in fact, I think it's doing pretty good, because I made the story, I've given the story before, that I went back on Duolingo and I went to the earlier lessons and I started just reviewing the stuff again, just to really cement it in. And then I went to the practice. When you go to practice, it figures out where you are. The practice sessions I had were very, very easy, because it said, hey, we just saw that you spend a number of hours over here. You probably need practice over here. But if I don't go back and practice and review, the practice sessions stay where I am, and they become very hard, and I get frustrated. So it's working. So they don't have to pay all those contract workers anymore. So, they don't have jobs. They don't have incomes. It is deflationary. And it is finding its way into almost every little simple thing. So no, it's not just because I'm waiting for something to break. If something breaks, I got a great hedge. Duration. Duration is a great hedge against something breaking, but something breaking is not an investment thesis. That's the reason to have a hedge. An investment thesis is you are expecting that yields will drop for two things, probably a benign growth environment and the specter of deflation. Are the other reasons, if inflation comes down but real GDP is strong, would you still be comfortable owning TLT? Yes, I would. How do you get the applied levels and understanding reserves, repos, balance sheet? Are they uploaded to YouTube? No, I have a separate series called The Applied Level, and it's on my website. I did answer you. It's at my name, markmeldrum.com. markmeldrum.com, and you'll find it there along with CFA content, and FRM content is there. Even though the LEI and yield curve 100% track record, do you think the sample size of recession is large enough for extrapolation? That's another fair point as well, is that your sample size is like less than 10. It's a small sample, but less than 10 with 100%. That's hard to ignore either. The small sample size, yeah, you got a point. For LEI, the overweighting of manufacturing, you got some points. These are valid points. So it's hard to ignore the track record of them, but I don't know that I would get married to the fact that they have 100% forecasted recession, and that I would position any assets I have for a recession. But in positioning your assets, what I was saying is it's hard to ignore them. It's hard to just say, I'm going to put them out of my mind, because there they are in my mind going, but hang on a second. What if they're right in the end? And after the fact, you look at it and you say, well, you should have known, right? 100% track records. But I'm just saying it's hard to ignore them. Agency released earnings Monday evening. What are your thoughts on dividend sustainability? Already answered that. I think the dividend is more than fine. 36 cents a quarter versus 60 cents for the quarter. I think we're more than okay there. Could we cover what is happening in China for the next update? Yeah, it's I think what is going on. Think about this in a sense that, let's say that China was humming along like this and it's starting to decrease. And this was the source of a lot of global demand. Meanwhile, India was humming along like this and it's starting to increase. That if you added the two up, you'd probably have stability. Could it be that the baton is just being handed from China to India? And that, yeah, China is a story, but I think you can't tell the China story without telling the India story. China falling, India rising. You got to put those together in a portfolio and say, well, China has volatility on the downside, India has volatility on the upside, but if you put them in a portfolio, probably boring volatility. One country's loss is another country's gain, I think. So you could talk about China, but by focusing on that, whenever something shrinks, think of the global economy like a balloon, and you're going to squeeze one end of the balloon. Something somewhere has to increase, unless the balloon has a leak, right? Unless the whole balloon is shrinking, one country can shrink, and if the balloon has no leak, that means some other country must be rising, or group of countries must be rising. Do you do most of your reading on a tablet? I do, on the iPad or the computer. Sometimes the computer. Excuse me. It depends on where I'm sitting, what I'm doing, what I want to do. Sometimes ergonomics, that's a big deal. I can't. It's difficult to find a comfortable chair if you're going to sit and stare at a computer screen, and you can't lean forward to read your computer because it just hurts. You're slouching forward all the time, and it's uncomfortable. So you have to, make the writing as big as you can on your. I have a 27-inch screen, so I can sit back and read it quite well. But mostly it's iPads, and there, if you have a good solid couch and the arm of the couch is just high enough to rest your head on, that's a perfect place to read. I should do a video on that, and the best couches for finance people to buy if you got to read a lot of stuff, right? My eyes and back really don't like sitting at the computer for hours on end. Neither do I. After moving to CR, your U.S. holdings would be taxed at 30-40% inheritance taxes. I don't, not with the setup I have. I don't believe that. No. And if anything, like, unless I get shot, like if I die unexpectedly, where I don't see it coming, then maybe there's a problem. But here's the thing: I have no ex-wives, no kids, no family, no nothing. I have nothing. So I'm dead. I don't care. I'm dead. I don't care. I mean, I don't care. I'm pretty sure that's how it works. Now, I haven't died before. I can't tell you, but I'm pretty sure that's how it works. But if I get something and I have a diagnosis, blah, 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 I would give away most of it before I died anyways. I would give it away anyways. I wouldn't wait for probate and probate fees and all of that. I would simply just give it away before that happened. So we're really looking at unexpected death. And if there is unexpected death, being that I have no one that depends on me, I have no family in that respect, and no one is waiting outside my door thinking he's going to die soon and we're going to get it all. There's nobody like that in my life. And like I say, I'm pretty sure that once you're dead, it kind of works that way, that you don't really care where your best sweater is anymore. Can you do a video about people who fail November 23? I'll do better than that. I'm going to do a live session. I'm just waiting for the level 3 results to come out so that I can do one live session for everybody. What are your thoughts on Peter Schiff? Crazy man. I've never listened to him. I think the craziest one to listen to is this. I think it's his name is Dent, Harvey Dent. He's been calling for an 86% sell-off in the market every year, every year that I've been doing this, and he just seems to keep getting headlines. You know, he just keeps people, different news outlets keep putting his story up on Apple News. You can scroll through and you'll find Harry Dent calling for an 86%. He's a crazy guy. Peter Schiff, I don't know. I don't know. There are some people who say the same thing year after year after year after year after year, and after a while you simply just stop listening to them because they keep calling for the same thing to happen. You kind of just stop listening to them. Beats me. I've never listened to him, so maybe he is more on the fringe, or maybe I've come across him and I keep saying, oh, this guy again. I already know his story. Maybe, I don't know. While referring to EFFR 12-month lag, you have spoken on the lines how some impact is still left to be felt. Can you please elaborate on exactly what this means and where all the impact can be felt? Well, it's theory, right? Like when you raise interest rates, it's not like everyone feels the higher interest rates right away. So if I have a 30-year fixed rate mortgage and no debt, raise interest rates all you want. It won't affect me. Companies use a lot of hedging instruments in place such that if interest rates do rise, it doesn't affect them because they're hedged. So their costs don't go up, but hedges roll off. So we've 2 years into an interest rate hiking environment. You know, you have some companies almost on a quarterly basis where their hedges are rolling off and they have to roll forward at higher hedges. Well, they're just starting to feel the interest rate hikes. Right? So that's why we say it works with a lag. Some companies will feel it right away. Some companies will feel it in 6 months because they may only have 6-month hedges in place. Some may not feel it at all because in 2020 they had 5-year swaps in place. They won't feel anything till 2025, and maybe in 2025 interest rates are back to zero again. In which case they're like, whew, wow, that didn't bother us one single bit. So it's what is the lag? You know, that if half the companies are hedged and half aren't, and we raise rates and half the companies are hedged for a year, on average, that's a 6-month lag. So there is some coalescing around the idea that maybe it's a 12-month lag. But there is some lag, so there is some of the interest rate hikes that just haven't been felt yet by some of the people somewhere. Is there an arbitrage trade available by shorting Fed funds futures in June? Since that when Bostic is implied, well, I wouldn't call that arbitrage, I'd call that speculation, right? Arbitrage means that you're long and short something such that you create a risk-free position with more than a risk-free rate of return. There is no arbitrage here. I think you mean speculation. As you mentioned, 1058 onwards, the Fed funds futures curve should ideally be flat till June. If we believe that the Fed won't do anything till the third quarter, it should be flat till June. It should be. So there is a speculative element to that. But if Israel launches a nuclear weapon at Tehran to take out the whole city, then forget it. You will get crushed on trading that, because money will fly into U.S. treasuries, yields will drop, the Fed will start cutting rates, the globe will just have a fit. They'll have to do something, and you'll get crushed. You can do that. But you are inherently short an external event when you do that. Yeah, you know. I say Israel because Israel has nuclear weapons. I didn't say Iran strikes Israel, because Iran doesn't have a nuclear weapon. I had to pick somebody with a nuclear weapon. I picked one. It could be Pakistan. Pakistan might just get tired of being pushed around by Iran and just say, okay, Tehran, you have no reason for existence, and take them out. Could you please explain why we look at the weekly OAS? It's because it's the best measure of credit spread. If an option, a bond doesn't have an embedded option, its OAS will be its Z spread. If it has an option, then the Z spread is not appropriate. We would look at the spread adjusted for the option, so we look at OASs, option adjusted spreads. Has anyone ever told you bear a slight resemblance to one of Canada's greatest export, Norm Macdonald? Nope, never heard that before. I've never heard Norm Macdonald. When I was younger, I heard Harrison Ford and Sean Bean. Sean Bean being Boromir from Lord of the Rings. I heard that, but never Norm Macdonald. But I don't know. Maybe you think all Canadians look alike. Could you touch on your thoughts for agency's presentation? I already did that. Also, did you load up on DHI? No, I didn't do anything there. What actually is the Fed reserve balance, and why is it going down matter? That's hard to explain in a very short period of time without holding a whole seminar. Reserves are cash the banking system has that it doesn't know what to do with. There are no loans for it. And rather than putting them in securities, they can leave them at the Fed as reserves, and the Fed pays an interest rate on them. And because they leave them at the Fed, and the Fed pays an interest rate on them, the Fed can use the interest rate on reserves to conduct monetary policy, as opposed to using open market operations to conduct monetary policy. It just makes it easier when you have ample reserves. You can get that done. Bit confused about capital market expectations regarding long-term bond yield. According to CFA, 10-year bond yields pull towards a trend growth rate of nominal GDP. True. Generative AI boosts the trend GDP growth of the U.S. by 1%. Inflation remains stable over the long run. Then the U.S. long-term yield should be higher, leading to lower prices for the 10-year Treasury than before generative AI. Not necessarily. You to say that inflation would be stable, that is a big assumption to make. If you say that generative AI will boost growth by 1%, generative AI is job killing, which means jobs will decrease, and that is aggregate demand, right? Aggregate demand, it comes from employment, which means it would negate the 1% increase that you already got. So while it is productivity enhancing in the application that it is in, it would be broadly deflationary, right? So I think that the deflationary component of it would outweigh the productivity or the potential productivity increase that you could get. I don't know that you could have a beautiful forecast for growth in GDP from generative AI without an effect on inflation. I don't know that you can have those two happen together. So I would question your all other things being equal part with inflation. Am I doing some math wrong on equity risk premium? I did answer you. The equity risk premium is just 1 over the PE, right? The price earnings would be your equity risk premium, because it's just equity over price. Well, if you got the PE, it just means you invert it, and that's the E over P. At a multiple of 20, forward multiple of 20, you're about 5%. IG bonds yield more than that. So you can get into an IG bond that yields more than 5%. Money market securities are yielding more than 5% right now. So yeah, it's a tight equity risk premium right now, a very tight equity risk premium. Earnings Whispers has a good calendar. We'll look at that next week. Earnings Whispers. I used to look at that all the time years ago, and then you drift away from one thing and another, and then you tend to forget. Yeah. Considering starting a business where I put together research reports for companies.
I want to make sure the reports are the highest quality, especially given your videos critiquing the short reports of ABR. Well, first of all, the short report of ABR, I mean, it was easy to critique that one, even though it was a CFA that did that. At least we think it was a CFA that did that, because they didn't dive deep enough. I mean, you read to do a short report, you can't somewhat know. There was this great chart that I saw, and it was about unconscious and conscious knowledge. This unconscious, a lack, or that you had this unconscious, I forget what it was, but it was about knowing something where you know very little, and you know a lot, right? And it broke it down into 4 grids, right? And down here is the, what you don't know. It's the unconscious lack of knowledge or something, is that you're unaware of what you don't know. That you're unaware of what you don't know, which means that you think you know what's going on. And then as you learn a little more, you become aware, you become conscious. You go from unconsciously not knowing to consciously not knowing. You are aware of what you do not know, which makes you better right away, because you say, oh, there's so much I don't know, that you then get to a level of competency where you are aware of your competency. And then there's a level above that called unconscious competency, where it's called intuition, where you don't know why, you can't really put it in words, but you know so much about something that there's something else that happens unconsciously because of that. And I think that writer was sitting down here and probably thought they were sitting up here. So it's a matter of how do you know what you do not know? Well, you don't. You keep reading, you keep learning, you keep listening, you look at other sources, you listen to other people, and slowly and slowly and slowly over years, you become an expert. Over years. There are things I learn every day. I'll pick up a company's 10K, I'll start reading and go, oh, I didn't know that. And that little bit might add to something I know somewhere else, right? And I every day I become aware of, well, I know nothing about this. So I'm becoming aware every day of the things I do not know. But I think the writer was over here. Let's see. I was wondering if you would be willing to look at the report I've done, provide any feedback, or if you know someone who would be willing to look at the report. The best thing to do is crowdsource that, is get yourself a Substack. Get yourself a Substack account and start putting your stuff on Substack. You will get comments from people who know more than you. That's what you want. Not just one person, but people who know more than you, and a lot of different people, and they will make you better. Your audience will make you better. If you take their criticism and you say, okay, well, I need to raise my game, or they point out where you went a little bit wrong, don't be afraid of criticism, right? Just you put it out there and let the market give you some feedback. If it's good stuff, you'll see that those people following you on Substack, the numbers start growing. And if those numbers start growing, that's the market telling you that you have something of value, right? If you don't have anything of value, nothing will happen. But this is what I would suggest, is get yourself a Substack account and just start publishing. Okay, also I feel using modules language for learning Spanish, something rapid for use, and I think trying to translate it as I read it. I don't have all the words, but I'm getting quite a bit of it. But it doesn't have anything to do with finance. How long before we get a market update? In a long time. I'm on it's 39 days I've been learning this, and I can carry on basic sentences with my staff. I can, say what I want, and I can, if they talk slow and I motion for them to slow down, I can understand most of what they say on an everyday basis. So I am getting there. When I listen to some people talk, this one person that comes around to do some work talks so fast, I can't figure out where one word ends and the next word begins. They talk so fast, I can't figure this out. I don't know what you're saying to me. And even when they slow down, it's like if you've ever listened to my videos at 1.5 times speed, imagine listening to a language you're learning at 1.5 times speed going, I can't figure out what you're saying. and it becomes frustrating. Someone in his 30s, 2 years to beat the market, negative 24 in 202, 12% in 2023. So I would much better just 100% SPY, but how can you do that? Well, leading indicators pointing to a recession, inverted yield curve. You got a long-term horizon, which means you don't have to invest fundamentally. You can invest with the assumption of equilibrium. In the long run, the market does find its equilibrium, which means over the long term, you will get an equity risk premium. In some periods it may be low, some periods it may be high, but if you just follow CAPM for a well-diversified market, you have a beta of 1, whatever your risk-free rate is, plus 1 times your equity risk premium, 4.5%. You can think of that as an expected return, plus your dividend yield, right? Capital and dividend yield. Over the long term, you should get 10 to 12% in equity. So some years might be 1%, some years might be 30%, but you just buy SPY, and next quarter you buy SPY, next quarter you buy, you'll get the long-term average growth rate of SPY. So don't worry about tomorrow. You're in your 30s, you got a 30-year time horizon. Just keep doing that. Just keep doing that. I've started to just allocate a fixed amount of money to SPY every month and kind of forget about trading the market. Yeah, that's fine. That's fine. To confirm a point you made, you were saying reverse repo can effectively be used as collateral to buy long-term treasuries. You can borrow money in the repo market to finance long-term treasuries. You have to understand what is going on in the repo market, right? On one side you have collateral, the other side you have cash. So you have collateral on one side, you have cash. No matter what kind of trade is going on, somebody has the collateral, somebody has the cash. Whoever has the cash has a money market security, because this cash is a term repo. It's either overnight. The majority of repos are less than 3 months, or 3 months or less, right? So whatever collateral this is, it does create a money market security on the other side. Whoever has the cash basically has a cash rate. The repo rate, that's a money market security. This can be anything. The majority, over 90% of the collateral, has a maturity greater than 1 year. So they are not money market securities being pledged in repos. They are all kinds of bonds being pledged in repos. The important thing is whoever has the cash has a money market security. So it doesn't matter what the collateral is. It matters that you can create a money market security out of any kind of collateral. There are no money market securities, but there are lots of 30-year bonds. Well, what you can do is you can lend money against a 30-year bond. And if you lend money against a 30-year bond for 60 days, you have created a money market security. So I have answered that one. Work investment advisor, wealth management division of the bank. I receive incentives to add structured products to my clients' portfolios. Curious about your perspective on structured products. Yeah. I have no problem with them. You consider making a video for the applied series? Not really, because you can, I mean, the world of structured products is endless. You know, it's like, well, if I do something for the applied series, would I be doing it based on how to create a structured product, or would I do it based on structured products that exist? Lots of structured products out there. Lots of structured products out there. But yeah, you can get that done. I mean, if you decide that, hey, listen, you know, I like this covered call business, well, there's structured products that automatically have covered calls in them, right? There's ones that have, it's endless what is out there. For any structured product is, well, how big is the potential market for this product? Recording, check your audio levels. I do, because I've had this complaint quite a bit on YouTube. Oh, I can't hear you. But on my end, you know, I listen to the video and go, I don't hear anything. It sounds just as loud. And I do, in Final Cut Pro, boost the audio levels up about 5-6 decibels, saying, okay, well, let's just boost it then. So I'm at a loss as to what's going on there. If you please consider including a summary at the end of your weekly outlook with a timestamp. hard to summarize because sometimes one screen is just a whole bunch of small detail. You keep saying Canadian REITs are a buy, which to me makes no sense living in Canada. The housing market is unaffordable for me living in Vancouver, and I make more than the median wage. You're making my case. I know you're magnitudes over me in terms of smartness and understanding. Well, I wouldn't say magnitudes. Could you please do a deep dive on the Canadian housing market for BC and Ontario? I want to understand how to reach a conclusion. Well, if you can't afford a house, you got to live somewhere. Chances are you're renting somewhere, and you got to pay whatever they ask. Aha, there you go. I want to own the buildings that you have to live in if you can't buy a house. The more unaffordable housing gets, the more immigration, the pace of immigration into the country exceeds the increase in the supply of new homes, the more apartment buildings can charge more for their apartments, because where are you going to go? A tent? Where are you going to go? Right? So you're going to pay whatever rent they ask you to pay, and the stock of housing is not expected to keep pace with the pace of immigration. And Trudeau does not have to call an election until 2025, and he won't if he doesn't have to. He is going to hold on to that office for as long as he can. He's not going anywhere. He's not going anywhere until he's voted out. But he's not going anywhere on his own. He's not willingly going anywhere, and he's going to keep doing what he's doing. So even when he's done, and you do get more reasonable levels of immigration, you still have to deal with the population increase that you had that cannot afford homes. You still have to build those homes. They just, and listen, the regulation is unbelievable. You buy 25 acres, it could be 2 years before you can start building on those 25 acres with just all the hoops you got to jump through. So yeah, you got to live somewhere. That's why I think apartments are great. Clean interface, but wrong. AXP is Friday. CAT is expected the week after, not next week. Yeah, well, something's going on with the with earnings, because the SP Global spreadsheet is off. IBES is off. I don't know. Everyone seems off. They used to be pretty precise. Now they're off. Next week we'll try earnings whispers and see what they have. But I think they do more than the S&P 500. And if they do more than the S&P 500, then you got a whole bunch of stuff that you got to weed through, and a bunch of companies you probably don't care about just to get to the 500. So, it is what it is, and that's it.